we find ourselves at one of the most crucial moments in Bitcoin's history, a moment that will usher in tremendous opportunities for the adoption of cryptocurrencies in the coming decades. It will bring about a new wave of crypto millionaires who will navigate this surge of interest and capital flowing into Bitcoin and the crypto world. Blackrock, the world's largest asset manager, is indeed on the verge of approval from the SEC for its spot Bitcoin ETF. The approval of this financial instrument will set off an unprecedented chain reaction, with other major asset managers and financial institutions launching their own ETFs, promoting widespread adoption of Bitcoin in the United States and around the globe. Even the opinions of the world's most significant investors in the crypto space seem to be particularly enthusiastic about this news. One example is Michael Saylor, the chairman and founder of MicroStrategy.
Well, I think you can't really underestimate the significance of the spot ETFs. It's not unreasonable to suggest that this may be the biggest development on Wall Street in 30 years. I mean, the last thing that was this consequential was the creation of the S&P index and the ability to invest in all 500 S&P companies via one trade at the same time.
In this video, we will explore the reasons why BlackRock's spot Bitcoin ETF is the game changer of 2024, what sets it apart from other approved Bitcoin ETFs, and what benefits the crypto world can expect from this unprecedented event. But let's start from the beginning. Firstly, who is BlackRock and why is it so important that this initiative comes from them? BlackRock is the world's largest investment management company. Founded in 1988, BlackRock manages a wide range of financial products, including mutual funds, pension funds, exchange-traded funds, and other investment vehicles. What makes BlackRock unique is its global scale and reach. The company has become one of the major players in the investment industry, with a significant presence worldwide, currently managing almost $10 trillion, more than Vanguard and nearly 3 times that of Fidelity. BlackRock stands out as a financial giant. To give you an idea, $10 trillion is equivalent to the GDP of Germany, France, and the UK combined. This level of capital makes BlackRock the most influential financial company globally, attracting investments from the largest corporations, sovereign states, and investment funds in the world. Furthermore, BlackRock is the leading player in the United States for funds raised in ETFs, with nearly $2.5 trillion as of September 2023. Precisely the financial instrument designed to promote investments in Bitcoin. Just this fact alone highlights the significance of this milestone, coming from the asset manager that effectively dominates the global financial market. The IBIT Spot Bitcoin ETF proposed by BlackRock is not the first ETF on the Bitcoin market. So what is the difference between this instrument and the other previously approved Bitcoin ETFs? The Bitcoin ETFs approved by the SEC so far are based on futures, while the ETF proposed by BlackRock is a spot Bitcoin ETF. Despite appearing similar, there are substantial differences between these two financial instruments that make BlackRock's ETF unique and the only candidate to capture the interest of institutional investors. The first difference between these ETFs lies in the fact that futures-based ETFs hold futures contracts on Bitcoin as the underlying asset, whereas the spot Bitcoin ETF holds Bitcoin directly. Simply put, when you purchase a futures-based ETF, you are not directly buying Bitcoin, but a financial instrument that commits the asset manager to buy or sell Bitcoin at a predetermined price in the future. This results in the ETF's price and Bitcoin's price not necessarily coinciding, as the asset manager buys a financial instrument tracking the expected price of Bitcoin in the coming months. On the other hand, acquiring a spot Bitcoin ETF nearly perfectly aligns the price of the ETF with the price of Bitcoin. This difference carries significant consequences, including the second main distinction between the two instruments, the management of the ETF. We mentioned that the futures-based ETF buys and sells futures contracts, which have an expiration date. This obliges the asset manager to view and purchase futures contracts at specific times of the year, causing management and risk control complications. Complex management, not present in the spot Bitcoin ETF, results in a higher fee for those holding a futures-based ETF compared to spot Bitcoin ETFs. On average, these instruments have a price around 1% to 2% For instance, if an ETF is purchased with $100,000 with a 2% fee, $2,000 will be paid to the asset manager, who will invest the remaining $98,000. A spot Bitcoin ETF, having simpler management, will have a reduced cost estimated at a fee between 0.2% and 0.5%. Much less considering these are recurring fees. This factor is particularly important considering that major financial institutions also tend to sell these products with a markup to clients, incorporating more than one ETF strategy into the portfolios offered to them. Finally, the third main difference lies in the fact that Bitcoin futures-based ETFs, in particular market situations, could be illiquid. Selling futures contracts during periods of declining Bitcoin prices could be challenging, causing management complexities for asset managers trying to track the Bitcoin price. From this chart, it is possible to observe how, in less performing moments for Bitcoin, futures tend to perform worse than the Bitcoin price, causing headaches for investors. On the other hand, BlackRock's proposed ETF, based directly on the purchase and holding of Bitcoin in wallets, would perfectly track the market price of Bitcoin, completely mitigating this management complexity during crucial and delicate market moments. Before moving on to the final section and identifying the main benefits that will follow the approval of the Bitcoin ETF, we ask you to like this video and subscribe to the channel if you want to receive further updates on Bitcoin and financial markets. Now that we have explained how this instrument proposed by BlackRock differs from previous tools approved by the SEC, let's understand the main benefits arising from this approval and the chain effects that will follow. The first consequence will be increased adoption by institutional investors, considering that the majority of Bitcoins in circulation are currently held by retail investors. BlackRock's participation in the cryptocurrency industry through an ETF may attract more institutional and retail investors, given BlackRock's role in the financial world and the trust it has built over time, attracting a diverse range of clients including banks, pension funds, insurance companies, hospitals, family offices. The creation of a BlackRock-backed instrument will likely lead to the adoption of Bitcoin by major investors. This, in turn, could have direct consequences on its price. Currently, BlackRock's clients span various sectors of the financial industry, and the creation of such an instrument by BlackRock could prompt large-scale investors to consider Bitcoin as a viable investment, even if only a small percentage of these investors decide to buy shares of the ETF. The impact on the price of Bitcoin could be significant. This is especially true considering that Bitcoin's market capitalization, within the context of financial markets, is relatively small when compared to assets like gold or the S&P 500. The second immediate consequence concerns regulatory attention and investor protection. BlackRock's submission for a Bitcoin ETF attracts regulatory attention and underscores the importance of clear rules and safety nets for the cryptocurrency sector. The involvement of a well-known financial institution in providing a regulated investment vehicle emphasizes how crucial it is to have clear frameworks prioritizing investor protection. In recent years, the main reason why major investors have stayed away from direct investments in cryptocurrencies is the associated risk. The possibility of cyber attacks and the lack of regulation on Bitcoin could have forced these large entities to liquidate their investments in certain market scenarios, leading to severe reputational consequences. By operating within a well-designed regulatory framework, there is the potential to open up these investments to institutional investors who, by principle, must comply with clear and well-defined laws and regulations. The third benefit, directly resulting from the approval of BlackRock's ETF, concerns the ripple effect it would have on the market. Given that such approval would attract significant capital inflows to BlackRock, it wouldn't be long before other financial institutions and asset managers develop their own versions of the ETF, exponentially expanding the number of investors involved in the industry. Notably, not only is BlackRock working on the approval of its ETF, but Fidelity, VanEck, and ARK are also in the process with the SEC to approve their own ETFs. The time is now.